the rainy
Raining day.
day.
I
Right?
remember our
So
Joko
I
said
think,
something like this. Yeah.
yeah. So the question says why investment is important. So when you list out all these points, you can just write short, maybe one sentence for each of them, each one sentence, not too much grammar. Then examine different kind of investments. So what are the different type of investments? Oh yeah,
Fixed
what
income
are the type
investment
of
and variable investment.
fixed income investment and variable
And variable income investment.
income
Then we can begin to
investment?
build
So
on that.
under fixed income, what do we have?
T-bills.
No. You said government and non-government, Abi?
Okay, government and non-government. Yeah.
Non-government security. Under non-government, we have CP, commercial paper. Then we have bill of exchange. Okay. Then under government, you have bond. You have treasury bills. All right. What else again? That's all, Abi. Then what
No,
are the variable? What are the variable investment? Example. This one too. We have fixed deposit. No, fixed deposit is not. It's non-government, Abi.
Yes, fixed deposit is non-government.
you have savings accounts also.
Are you talking about treasury certificate? Treasury certificate is under government.
Treasury bill. Now that's treasury bill. So
Maybe I
what are the
different.
variable? What are the variable income? What are the variable income?
Shares. Equity investment. As shares.
Treasury certificate, Abi.
Yes.
Then here we have equity. So I think we have done justice to the A part of the question, to the best of our knowledge. So in case you are still struggling to answer all these things that I've just answered, we have just answered now, not I, we have just answered. Let me stop with transcribing. I'm only recording. So in case you are still struggling, it shows that you need to read your book very well. All right. So the main event for today is this be part of the question. With the aid of data from 3 organizations, provide below. Determine which one will you prefer to invest and why. So when you are given a question and you are to analyze as a financial analyst on which investment that a company should do or not. Okay, when you are to do that, this is what you are going to calculate. You are going to calculate the returns and the risk of that investment. So you are not going to calculate only the return. You will calculate both the return and the risk. And when you are calculating risk, know that you are only calculating your variance and standard deviation. That's what you need to do under the risk. Then the returns, now you are calculating your expected returns or your average or mean expected returns or average or mean returns. So this is what you are to do under returns. So if they say you should analyze a company, you have to look at it from 2 angles. You don't analyze, the concept of this is about risk and returns, right? So you analyze the risk and you analyze the returns. So that is exactly what you need to do. Now, looking at this question now, we have 3 companies now: Gladstone, Johnstone, and Adiola. So let's start with Gladstone now, first of all. Let me hide this thing. So let's start with Gladstone. So we have the year. We have the year. How many years do we have? Year 0 to year 6, Abi. Yeah, let's say 1, 2, 3, 4, 5, 6. Okay. This is the number of years we have. Okay. This is the number of years that we have. Then after the years, what else do we have? We have the stock price and dividend. We have the stock price and dividend. Let me call it DIB. Let me just call this price. You know, nice stock price. Price and dividend. Okay. Now, so I need to call it 5.5. Year 0 is okay. Let's bring in year 0, although it is useless. But let's try bring it in. Year 0 is 5. This is 5.5. 5, 5.5, 5.8, 4.8. 5.8, 4.8. Year 4, 6.2, 6.3. 6.2, 6.2, 6.3. Then the last one is 7.01. Then we have this is the price, okay? Then we have the dividend. What's the dividend? Year 0, dividend is 0. Is 0. Then here we have 1.2. Here we have 1.2. 0.8, 0.9, 0. 0.8, 0.9, 0.
1.3.
0.90. You said 1.3
1.3.
and
0.9.
0.9. So this is the data that we need, Abby. This is our data. So you know, in this question now, did they give us probability? Did they give us probability, guys? We were not giving probability. Are you guys following, or am I alone here? We were not giving probability.
Yes, we have it.
Okay.
Yes.
We're not giving probability. We're also not giving returns, but we can calculate the returns. Professor Olowe taught us how to calculate return. So if you want to calculate returns now, let me do year 1 returns for you. Year 1 return is going to be RT minus RT minus, no, don't let me use RT. Let me call it the new price minus new price minus old price plus dividend divided by what? Divided by what? Tell me. Old price.
Old price.
Do you remember this formula?
Yes,
Abi?
old price.
So
Yes.
for year 0, your return is going to be year 0. So what's going to be return for year 1 now? Return for year 1 is going to be what? It's going to be 5.5. Hey, why is my hand slipping tonight? 5.5 minus 5. And they declare a dividend of 1.2. You get plus 1.2 divided by what? 5. So what's the answer, please? In times 100 over 1, please. Times, or just call the figure for me directly. I don't need times 100 over 1. What is the answer, please? We have to be very fast. So this is, we are doing this 0. What? Is it like
5.
this?
Yeah.
Sorry. I'm coming.
It's
Okay.
0.34.
I know it's not correct now. Who's calling? Somebody is calling 0.34. So you have to repeat that process for all the years. Do you guys remember this in that 0.34? So can we do for year 2? We have to be very fast. So you are going to repeat this thing for 3 company. What's for year 2? Year 2 is 5.8 minus 5.5 plus 0.8 divided by what? Divided by 5.5, Abby. Can we be very fast so that we can cover much?
0.2.
How much?
0.2.
0. what?
0.2.
Oh, yeah, you guys should do. Okay, do year 3 for me. Fast. Do year 3 for me. Year 3, year 4, year 5. Oh, yeah, share it for me.
Minus 0.017.
Minus.
0.017.
Oh, yeah. This one.
$0.29.
Is it 29? Are you sure? 6.2
Yes.
minus 4.8
Divided by
plus 0
4.
divided by 4.8. 0.29. Okay. Oh yeah, this
Zero.
one, this one.
2, 3.
Hmm?
0
point what?
0.016.
0.23.
0.0.
0.23.
23, yes,
23.
yes.
23.
Yes.
Oh yeah, the last one, the last one.
0.26.
0.26. Now, we want to, so what is our total returns, first of all? What's our total returns? So add up all these returns together. Add up all the returns. 0.034 plus 0.2 minus 0.017 plus 0.292 plus 0.23 plus 0.26. Total return is about 1.305.
1.305.
Yeah, so you now we are not giving probability. So when you are not giving probability, you look for your mean returns. Your mean return is what you are going to use for standard deviation. So what is the mean return? Mean or average return. So it's going to be 1.305 divided by 6 years. So how much is it? Divided by 6.
0.2175.
2175. So 0.2175, Abby. So now this 0.2175 now, this is going to be your bar X. So here you have return minus your return into bar. Sure you get, Abby? By your, let me call it mean MR. You know, before we used to subtract return from our expected return. But in this case that you don't have probability, you are going to use your average or mean return. So this will be 0 minus 0.2175. Are you guys getting me? 0 minus, no. This year, that's why this first year is meaningless. So you can as well just ignore this for row. Don't bother yourself about this. Start from year 1. So it will be 0.34 minus 0.2175. Abi? The answer is
Yeah.
0.1225. Okay. Oh yeah, do it like that. 0.2 minus 0.2175. So because we're not giving probability, we can't calculate our expected return. What we are going to use is the probability. Okay. 0.0. I mean, what we're going to use is the mean. It is the mean you are going to use since we are not giving probability. So you use the mean. So this one is minus 0.017 minus 0.2175. So this gives us minus 0.2345. Okay. Oh yeah, this one 0.292 minus 0.2175. This is 0.045, Ravi. Then this one is 0.23 minus 0.2175. This gives us 0.0125. Then this one is what? 0.26 minus 0.2175. So this gives us 0.0425. Now, so the next thing is the final stage is that you are going to square this, okay? You are going to square it. But don't worry, there is nothing like square multiplier probability. Just square it first. I'll give you the formula for standard deviation. You know, there are two ways of calculating standard deviation. One is with mean, or the other one is with probability. But in this case now, we are not giving probability. So we're going to apply standard deviation with mean formula. Okay, so so just square that figure for me. Square it, square it, square it. So whatever we have here, we'll square it. So 0, this will still be 0. This one raised to power 2 is what? 0.1225 raised to power 2.
0.0150.
0.0150. What about this one? 0.0175 raised to power 2. That's 0.306 62. We can say 63 now.
Yeah.
Then 0.2345 raised to power 2. This gives us 0.099.
05.
Yeah. Then 0.0745. 0.0745 raised to power 2.
Listen,
Yeah.
listen. This
Yeah.
your mean divided by average return. I think it should be mean equal to total return divided by n.
Okay. No, I say mean or I say or. They are the same. Or average return. Sure you get. Which is your
Okay.
total return divided by n.
Divided
Yeah,
by
just say
n. Okay. Good.
TR divided by n.
Okay.
TR. I just say mean is the same thing as your what's it called average. Yeah.
Okay.
Oh yeah.
Okay.
Next one. 0125 raised to power 2. 0.000153. Abi?
Yes.
Then the last one, 0.0425. 0.0425 raised to power 2. What's the answer?
Is 0.001806.
So let's total everything together. Total everything.
I got 0.0643.
Okay. Let me quickly do my own too, so that we'll compare figure.
I got 0.077. Oh, please confirm.
Ijati Shele,
I
bye.
got 07781.
Ijati Shele. 3 people, 3 different answers.
No, it's correct. 0.077.
Just hold on. Oh, 776. So this is what we have. Note, don't be deceived. This is not your variance. So you remember, these are what we need. These are the vitals. Number 1 vitals is our average return. Let me put them in green. What you are taking decision on. Number 1 is your average return. Then number 2, your variance. So your variance is equal to return minus MR. MR is your mean return. Mean return raised to power 2, like this, raised to power 2, divided by n minus 1. So this is how you calculate your return using mean. If we are giving probability, we will have just say, just hold on, let me bring this in. If you are giving probability, you will have just say this one multiplied by probability. But in the case you are not giving probability, you say m minus 1. So that's how you get your, what's it called? Your variance. So our variance in this case now is going to be this figure we have here, this one, divided by n is the number of years, okay? N is the number of years, which equal to, so this is equal to, this figure divided by 6 minus 1. So this is going to be our variance. So what's the variance now? What's the variance? So divided by 5. So me, I got variance of 0.0
0.001555.
555. So your last variables you need is your standard deviation. So standard deviation. So you know that one is, you will just square this figure. So the square of this figure is what now? Insert symbol. You will just square this figure. So if you square this figure, what do you,
Square root.
I mean square root, no verse. So 0.1247. So these are the three figures that we need. We are going to take decision on these three. But unfortunately, we are yes, sir. I am
This
with
your
you. We are
formula.
done with the first.
Return minus MR squared. I think you have a
Yes.
summation beside it. Summation.
You are correct, sir. You are very correct. You are very correct. So summation should be there. Where is it? Yeah, summation. You are very correct, sir. Yeah. So we are done with this first. So this thing that we've done now, we are going to do it for Johnson and Adiola. So when we will repeat it for the second company and third company, we will now take decision. Can you see that the question it looks so short, but you have to finish it in 30 minutes. That's the bad news. So we have just done, and it is very simple, in my opinion. It is very simple, but you have to fight against time. So we have done for one company now. But guys, do you believe that this is simple, Abby? Or what do you think?
Yeah,
Hello?
it's simple. We can do for the other
Simple,
company so that we
but
not waste
time
time.
consuming.
Or
You
should
need to
I
manage
Can
do the
we
remaining one for you?
can we go to another question, please? We'll do the rest.
Okay,
We'll do for the
you
other
can do the
companies and
rest
share
on
our
your
But if we're
solution.
going to do for the rest, can we know what the decision rule
Decision
is
part.
like for it?
It's
If
the
you can
Yeah,
highest
like
it is
one
where
now. The
we
one with the
highest
highest
one.
standard deviation is the one you will choose.
the one with highest. What do you mean, your guy? Osa. Why would you choose one with highest standard deviation? No, the one with the lowest standard deviation is the one you
Please
choose.
give us. So let's write
I'll
it.
be sorry.
Kazim, why
Sorry,
can you
lowest
What
write
is the
it
meaning?
down? When
What
we
is the meaning of
calculate
The one
it,
standard
we
with
are
the
going
highest
to
deviation?
write
return
the
now.
decision rule, please.
Standard deviation is
Like
measuring
Osa
risk.
though.
The higher
It's
standard
measuring risk
deviation, the higher
now.
the risk.
Okay. It's true.
Yeah,
It's
so
true. It's
you
true. The one
Okay,
with
okay,
the
okay,
highest
okay.
mean is the
Welcome.
one we choose, but
Welcome.
lowest standard
Ẹ
deviation.
káàbọ̀.
Osa,
Ẹ ti lọ far.
Highest mean, lowest standard
Osa.
deviation.
That is okay. So guys, can you complete this question now? Can we all complete it on our own? Or do
Yes.
you want us to
Yes,
attempt the
please.
second? Should we attempt the second company, or we should just move on to another question?
Let's move on to another
I need
question.
decision.
We
Please,
can
Let's move to
complete
another
it. Just
question.
help us
Let's move to
write the
another question.
decision rule, please.
Time no day. Let's move on to another question.
You've been told the decision now.
So
Okay.
that we just
Oh yeah.
help us take
Mr.
notes,
Kazim,
please.
1 house, please.
Casey,
1 house,
please move
please.
on.
One house. 1 house, please.
Okay.
Mr. Kazim,
Yes, sir. Oh, no, not Mr. Kazim. Kazim straight. Which one is Mr.? And I don't come on. Tell me,
okay,
what do you want to say?
so I want you
BBM ló
to
máa ń
state
hùwà
the
yẹn.
just state the decision rule in the material. So you get so when we are revising, that will stick into our brain. State the decision rule and let us move on.
Decision rule. Okay.
Exactly. Thank you.
A.
Thank you.
Company with the lowest standard deviation should be considered first. No, lowest standard deviation should be considered first. Also, with reference to the returns, company with the highest returns should also be. So most likely, any company with highest return we always have the lowest standard deviation. Both of them work pari passu. Okay, should be considered. All right. So let us take our next available flights now to another question. So this question, I will assume it is solved fully. So you go and figure it out. Now let's move on to another question. I want to take this one on Camel. It also comes out every semester. So let's take Camel. Camel.
Casey,
Sorry, Kazim, I have a question.
Casey,
Yes, sir.
Casey, I hope you are focusing
Yes.
on only the recurring questions.
Yes. Camel comes out every semester. So that's why I want to solve it too. It won't take us more than 30
Let's
minutes to finish
focus on
Camel.
only recurring questions, please.
Understood. Yeah, Iman,
Thank
you
you.
want to ask me something? Iman,
Yes, I want
go
to
ahead,
ask a question.
fast.
So my question is, this first question that we solved, it's under which topic? Is it under the introduction to investment?
Oh God, this is risk and return now.
Baba, leave topic.
Make we know
This
the
is
topic.
risk and
Pressure
because-
Tiwa.
The one you did in first
Yes.
semester section. First semester section A.
Governor,
They are in which
don't
topic?
affect your portfolio.
Ignore
Baba
it,
go
Dare.
give topic.
Risk
Baba
and
go give
return.
you question. Leave topic.
This
Ó
is
fẹ́ jọ
risk and
Baba
return,
go
portfolio
give
ni
you
Emma.
now.
question. Leave topic.
Emma Josanana.
Can I co- can I continue? Can I continue? Hmm? Time is running like anything. Okay, let's take
No,
this comment now.
he actually asked a good question, but he needs to know that Professor Lawyer doesn't work by topic. The man just set. He set question, nothing concerning with
Mm,
topic. So we just have to
mhm.
move
So
with that train.
thank you. God bless you. You've answered the question correctly. So the next question is this now. This is the next question I want to solve now. Just hello. So can you see the what I see in this question now? In the class, we were only taught standard deviation by probability. They never taught us standard deviation by mean. And all the past questions I'm seeing, they are standard deviation by mean. So you're expected to know it. So that's another thing too. You are taught how to calculate standard. You have
Azim,
always been
we
using
were taught
probability.
to.
Mean.
Dr.
Standard
Omar
deviation by
taught
mean.
us in. Yes, yes. It is in the
Dr.
notes.
Abba taught.
Yes.
Maybe I was sleeping that time. Maybe I was
It's
sleeping when they
first
were
class.
teaching.
No, it's first class. That was what it taught us. It's first class.
Okay. He gave you this formula that I use, Abby.
Yes.
He gave us this, and
Yes.
okay. So thank you. I want to talk with you. Okay. Now this is another question.
Oh, so in the notes later, Nicolo.
Are you talking about another class?
Madam, are we in the same class?
Okay.
Governor, I'm serious.
Hello.
But
Guys, let's move.
Your
Let's move.
class
Let's
is
move
different from
now.
our
It's
class.
time.
Okay.
Governor, you
Let's
don't
move.
do. Can move.
I think you guys are ready to even stay till 1 a.m. today. No wala. Me, I'm on leave already. If you want me to stay
Fire
till
on,
3 a.m.,
fire
me, I
on,
can
boss.
stay.
Fire
Me, I
on.
can stay till
Fire on.
3 a.m.
With you.
So look at this question one. What do you understand as camel? Don't think camel like sheep. Oh, no. What do you understand by camel as a techniques of evaluating the health of a bank? Why is it important and how could it be meaningfully used? First of all, let's define what is camel. CAMEL. What is so camel is what they use this in banking industry, right? They use camel in banking industry to check the health, how strong a bank is. Camel can determine whether a bank is failing or a bank is in order. So C in camel stands for capital adequacy. Okay, C in a camel stand for capital adequacy. A in a camel stands for asset quality. What is the quality of the asset of the bank? Then M in a camel. Please note, so C is this one, A is this. Then M stands for management quality. M stands for management quality. Take note of the M. M stands for management quality. Then E stands for earnings, the money they are earning. Then L, I think L stands for, is it loan or liquidity? Yeah. L stands for liquidity. Yeah, liquidity. So this is what Camel is. So you will just explain this. So to save all the stress, I have a solution already on my ChatGPT. Let me help you with the solution so everybody can go and read it on your own. So let me save you the stress of explaining it. So this is my ChatGPT. I've already read about it. So this is what Camel use. Camel is all about. So take this. This is the solution. Okay. So let's read it quickly. Let's read this quickly. So Camel basically they use it in checking the health of a bank, how strong a bank is. You can use Camel to know a bank that is failing. So like I said that the capital adequacy is this measure a bank capital in relation to its risk-weighted assets. It assesses whether the bank has enough capital to absorb potential loss and protect depositors. So this is basically the capital of the bank, which is like the shareholders fund, divided by the asset minus liability. So whatever. So you just confirm that whether the bank has enough. Then for the asset quality, in the balance sheet of a bank, loan and advances to a customer is under bank assets. Don't be deceived. When you see loan and advances in the balance sheet of a bank, it is under their current assets. So this asset quality, this one is basically you divide your provision for bad debts divided by your total loan and advances. That will give you your asset quality. So that ratio must be very small for you to know if the bank is performing. If the ratio of their bad debt to total loan is high, that means they need to go and fire all the bank, just like what bank PHB of those days did. Erastus Akingbola, they give out all the money to their friends and partner to embezzle the money. So management qualities too. You check the effectiveness of the management. Are they very strong or not? So that's M. Then earnings. You check the earnings of the banks. How profitable are they? Then liquidity simply means the ability of a bank to meet up with its short-term need. So the Kame techniques help investor, regulator, and banks to understand the overall health and efficiency of a bank. So if you that is just what you need to know for this number 1A part. What do you understand by Kame as techniques of evaluating the health of a bank? Why is it important and how could it be meaningfully used? So that we have answered it. Now, the next thing we want to do is that so this question you see here, we need to now analyze this bank. We need to analyze this data using Camel. So you are going to analyze it one by one. First, let's analyze 1B. Let's analyze with capital how many we have the various years, Abi. 2016. Oh, I think I have to draw table, Abi. We need to analyze it. We analyze the capital adequacy, we analyze the asset quality, we analyze the management quality, we analyze the earnings and liquidities. For example, now, for capital adequacy, it is their capital. This is the capital, right? So what is capital adequacy talking about? Capital adequacy, it measures a bank's capital in relation to its risk-weighted assets. So you will check the assets that are risky. KO, yeah, speak, please, fast. KO, you raise your hand.
Sorry,
Yeah.
I just want to ask: Are we taught this topic on in the class?
It doesn't follow any topic, but it is a regular question in past question. So I just feel like I should discuss this with us. So it's a regular question in the. It doesn't fall under any of our topic, but it is a regular something in the past question. So I just feel I should take it since I've read it. Professor Lowe still. This is if you check the past question, like okay, I don't need to repeat myself again. It's something that comes out every time in past questions. So yeah. All right. So
Casey,
like
this question
capital.
will actually
Yeah,
come out because
sorry, who is speaking?
Professor Nuruddin Adewale from Unilag.
Okay, sir. Thank you, Professor.
So,
Yeah, speak.
so this question will actually come out. Ask me why.
Please.
Professor,
Why, sir?
Professor Olowell, yes. Professor Olowell actually like to be talking about banks. So take note.
Thank you. Ifati, I want funny. I want to be like you, sir. So if you're on this call, please just understand what we're explaining. At least I've explained. I've explained what is camel for you now and the various ways you can measure your camel. So we need to now do these 5 camel tests based on these financials now. So look at what capital adequacy is testing. Capital adequacy is measuring a bank capital. What that means your shareholder divided by what? They said divided by what? By in relation to its risk-weighted assets. So which of these assets is risk-weighted in your opinion? So it's going to be this risk-weighted asset is the loan that they have given out to people. That's the risk-weighted what? Assets. So it's going to be your shareholders fund divided by loan and advances. So loan and advances is the risk. What if those people refuse to default in their loan? That can signify the end of the bank. So if you are calculating, should I just explain it or without calculating so that we're going to do it on our own? Should I just give us the formula? What do you think? So save time. Or we should
Calculate, please.
Eh?
First one.
Let's
calculate
calculate
it.
it because
Sharp.
I'm seeing it for the first time.
Please.
Okay, I'm looking at time. No. We have plenty of questions to solve.
We can just
So
calculate
how many years?
1 year each. 1 year each.
16 to 20. We have 16 to 20. So this is the details. This is 16. This is 17. This is 16. This is 17. This is this is 18. 19 and 20 will be here. So 20, 16. Okay. 2017, 2018, 2019. This one there. That's all done. This thing is messing me up here. Okay. Okay, I think it's making sense now. Once I'm able to finish 1 year, then okay, so we have 16, 17, 18, 19, and 20. So that's it. We have our template ready now. Our template is ready now. So the first thing I want to calculate is the capital adequacy. Capital adequacy. So what's capital adequacy now? So capital adequacy is this. I'm going to do my shareholders fund divided by loan and advances. So this one is equal to shareholders fund divided by loan and what? Advances. So that's your capital adequacy. So whichever ratio is the highest, that's what you do. Are we told to rank? Are we told to rank? They just say we should calculate now, Abi. Let's check. Because it is the same bank. We are just doing for multiple years. So it is the same bank. Let's read the question. Given data below, examine the area of strength and weakness of the bank. So we'll examine the strength and weakness. Let's do it. So for 2016 now, we'll say 48. I will go to be typing on this long figure. Let's just say 48.5 divided by 227. Abi, 48.5 million. This is 48.5 million. 48.5 million divided by 227. 227 million. So this will give you your capital adequacy. Just a minute. This thing will be very so sweet with Excel. Yeah, so 48.5 divided by this, then you get your answer. So you repeat the same thing for 0 what?
0.02136. That's 0.02.
Convert it to 100 in percentage. What is it? Just convert it to 100 over 1. What is the capital adequacy in percentage?
26. That's
21.37%.
21.37%. So this is their capital adequacy. So you do the same thing for 2017. Let's do for 2017 and we'll move on. This is 49.6 divided by 215. 49.6 million divided by 215.
Times 100.
So what's the answer in percentage? What is the capital adequacy here?
23.07.
0.07.
23.07.
23.07. 06.
So I think it will always, so you can complete the rest on your own, Abi.
Yes, sir.
Can we do that for capital adequacy? Now the next one is the asset quality. Let's do asset quality. Now for asset quality now is equal to provision for your loan, provision divided by loan and advances. Loan and advances, L and A. That is asset quality. is your provision divided by loan and advances. That is asset quality. So what is the provision for the first year? Total provision is 2.8 divided by 227. 2.8 divided by what? 227. So what is the answer in percentage? This one, the ratio must be very low. Then the second year is provision is 4.2 divided by 215. 4.2, sorry, 4.2 divided by 215. So what's the answer? You
The
get
first
you
one,
get your
the
answer
first
in
one is
percent.
1.23%.
1.23%.
So yeah, the second one is what? Your loan provision must be very low. I think there is something called prudential guideline. They have a standard, but in this question, I don't know how we're going to take decision because they never gave us a standard. Abi?
1.95.
1 point. Let me stop here for this one. 1.95. So if you check what I'm saying now, they did not give us standard. They just say we should choose. So what are we benchmarking this solution with? Me, I don't know actually. So let's solve
I
everything.
think
We'll leave it for them. Like,
Kazim.
mm,
Kazim. Okay, so I think in my
I'm with you.
in my experience and understanding, I think the idea is that we should we're not really benchmarking against anything but the strengths and weaknesses. And since they have given us multi periods, the idea is just to make a comparison of those periods, and we can see the periods where there were weaknesses and there are strengths, and maybe just put a brief comment on the areas where there were strengths, that in capital adequacy, the company does performs well. In asset quality, the company needs to improve. Just generic
Maybe they
thoughts
perform
like that.
well. Maybe they perform well in 2016 when compared with 2017. Then in
Exactly.
2018,
So it's more
in 20
exactly
in 2018, the
exactly like that.
performance went down. So you just do a general analysis, Abi. All the best if you have the
Yes,
time.
it's
So
just
management
it's looking like a general analysis.
yeah. So management. This is a lower question. I'm very sure of that. There is not anybody can tell me that it's not a lower question. Management quality.
I don't understand.
So for the
It did not teach this. You just set it. Jesus.
so we've read the capital adequacy. You are even happy that we are solving. What if you see it in the exam and at least we are happy that we are taking it here together now. So if you see it in the exam, it's not new to you again. So capital adequacy, we thought asset asset quality, we've talked about it. Then management quality. Hello, this one is looking at the efficiency of the management. So let's read now. Let's read management quality. Let's read management quality. This evaluate the effectiveness and quality of the bank management, including its ability to make sound strategic decisions, manage risk, and comply with regulations. So how do you think we can manage management quality here now? Me, I'm thinking of, they gave us the number of staff. What is the number of staff is? So me, I want to say maybe I should divide my earning by the number of staff. Then I will know what is really the rate we are getting from each of the staff. So that any year we have a high number of staff, does that translate to high profits? Or we are just recruiting blindly? Like any year we have a high number of staff, what is the benefit any we are getting per staff? The earning should grow for us to know if the management are performing. I don't know if anybody have a better way of analyzing management performance here because I struggled. Does anybody have any way of analyzing management performance apart from what I said?
Kazim,
Anybody, please.
how about profit after tax? Is it not also something we can use to
After
benchmark?
tax is considered something that are not within the control of the staff now. Your admin expenses may not be within your control, your tax. So it's better to use contribution, which is your gross earning. Those are the one you
But
can manage. You cannot manage.
Okay.
You cannot manage profit after tax now.
Okay, but you realize that profit after tax considers payroll costs. So the cost of the employee has already been factored in. For gross earnings, you can be making more earnings per staff, but maybe the staff cost might also be a very high area, and maybe there is poor cost control. which
No,
affects.
I disagree. I disagree
Okay.
with that analysis, sir. What is the any? Any means the effort of the staff in generating revenue. For example, look at 2016 now. 1,011 staffs, all of them combined together, we earned 53 million. Then look at 2027, we increase our staff to 1034. They earn 62 million. Then look at this ones now. Our staff dropped to 1021 and they earn more money. So that is the approach. I don't know. Please, let's brainstorm. Any other person, please. Should we use the growth or the profit after tax? Who else want to contribute here?
I will go with Emmanuel. I will go with Emmanuel. So it's profit per employee actually.
Casey,
So I'll go with Emmanuel. It's profit
Casey,
per employee.
Casey,
Yes. Yes,
any
hello. Yeah, I'm
day,
with you.
any day, anytime, investors are interested in what they are taking home. So whenever we are assessing management, it is based on my take home. So
Okay, so we
the
should use profit after tax.
Is the best way. The best,
Yeah, exactly. Profit after tax.
what would have been the best, which would normally use before if is available, is revenue. But when revenue is not available, the next one is profit after tax.
But revenue is the gross earnings now.
No, are you sure?
Yeah, gross earnings.
Okay. Does anybody have any? Is that our final conclusion, please? We should assess the management quality.
To go with profit after tax.
Okay, so
Mr. Kisi, it's a subjective question.
Yes,
it's a subjective question. It depends on the way you see it. There are many parameters by which you can measure the management quality. You can use return on investment. You can use inventory turnover ratio. You can use some asset turnover ratio. It depends on your perception to it. You can also use profitability or financial leverage. Depends on the way you see it.
No investor will go with asset turnover ratio.
The
Every investor
focus
will
of
either go with profit after tax or return on investment. I'm after my return. What is my business with your asset turnover ratio?
Bottom line. That's what we show on
if we are to use return on investment, we can say profit after tax divided by shareholders fund. What about that?
Correct.
Profit if you are to go with ROI.
Perfect.
Our ROI is the profit after tax divided by the shareholders fund. I think that is okay.
Correct. Perfect.
Or we can even calculate dividend per share. Just say this profit after tax divided by shareholders fund divided by. Okay, let's just do ROI straight away. I thought I wanted to use employee. So we say profit after tax.
Correct.
Divided by shareholders.
Correct.
This is the correct one.
Correct.
Shareholders fund.
Yeah. Anytime.
Brainstorming is good. It's good to brainstorm. Yeah. Yes, tell me.
I don't know, but does this not already enter into earnings? The fourth quality, the fourth listing of Camel.
We are going to any quality.
I know. I'm saying that formula doesn't already speak a bit into any earnings quality, because it's earnings quality that we can talk about ROI in that sense. I don't know. I just see it that way.
Let's look at the definition they gave earnings.
Let's check again.
Moreover, that formula is talking about return on equity.
Which one?
Return on equity.
Exactly. It's already ROI.
Return on equity, return on investment. It is when you are doing when you are doing investment analysis, you have a investment. But in an account like this, it is our equity will use as a investment now.
But the equity,
we're talking about staff.
Now this talking about management staff entirely.
In fact, even these earnings we can use only PAT, because it's measuring bank's profitability in terms of earnings and stability. How they have been able to maintain that profit. So if I have a consistent growth in profits, I have solved the earnings part.
Because
I can see stability there.
Okay, so I'm thinking maybe this formula here should go for the Henny, right? This formula we have here should
No,
go for the
no,
Henny.
Casey. This is fine for management quality. Under
Management
earnings,
quality.
we are only looking at the profit, the stability in the profit, the
Okay,
trend.
let's do this first. Let's do this for management quality. Our part is 2.5 divided by 48. Okay, 2.5 divided by 48. So you calculate it for this one. Okay, then the second year part is 2.3 divided by 49. 2.3 divided by 49. So you guys calculate it, decide. Now let's move on to the next one. So we have done CAM. E, any quality, any and liquidity. So let's check the.
Do you remember our lowest first class? He asked us a question. Which is more important, management objective or a shareholders objective? He asked us that question in our first class, and he told us, any day, anytime, it is shareholders objective. And we all know what shareholders objective is. So let's just think towards that line. Then
So
we will know
which formula are we going to use to assess the quality of the Henny? That's the next question now. So the Henny, this assesses the bank profitability.
PAT straight.
PAT divided by what? Or we are not applying anything on it?
We are not dividing it. PAT straight.
Total deposit is okay. Okay, let me check ChatGPT. Sorry, how to assess
Kazim, okay, as you are typing.
Under Kame. Yeah.
As you are typing, I think one other way that we can measure earnings quality is more or less profit margin, maybe in terms of net profit margin, gross profit margin, and the rest of that. So we could consider it from the perspective of profit over sales, right? And sales for a bank, of course, is gross earnings. So PAT over gross earnings. So this one is assets.
Return on assets.
Oga, see, the formula we use for net income over shareholders equity now.
Let me have
what we use for
what about this?
This management quality is what the ChatGPT is saying that we should use for any. Do you understand, Diron? This management quality is what the ChatGPT recommend that we should use for any.
Let's do the same for management quality. Let's ask ChatGPT.
I'm coming.
What is recommending?
I'm coming. So parts, we agree now that this one is parts divided by this. So this is for management quality. This is, so we are done with any. Let's check ChatGPT on how to measure management. I know what we are doing. We are brainstorming, right?
Correct.
I know what we are doing. We are brainstorming. How to assess management quality under. Hey, who is that speaking now? Person should mute. How to assess. Okay, this one is talking more about very subjective analysis, right? It's not giving us any formula. Can you see it? It's not giving us formula, it's just writing story for management quality. Are you sure we're going to, maybe that will not be part of what we analyze now, since we don't have the.
What you want to analyze?
Let's go with gross earnings.
Factors that you put in management. Because in management, you manage human resources. Coyote speaking.
Okay, Coyote, you said we should do what?
In management quality, you have several factors that you can use to measure management, because in terms of human resources, in terms of even performance of your, for example, this bank now, for them, deposit is very important for them, because from deposits, there are funds that they can, get from there as earnings. Even loans and advancements, you can tax your management to give out loans and advances so that they can generate more income from there also. Innovation is also key. So management is very broad. So I would suggest that we go with the number of staffs and the what's the other one there?
Gross any?
And the gross any. Yes.
Yeah, that was what I thought before. Before I wanted to know what is the each of the staff is bringing on board. So I will go with gross any divided by the number of staff. That's what I thought before. So that because they gave us that number of staff for a reason. So this one will be 53 point something divided by, how do I do this one now? So just divide it two. You can sort it this one out with yourself. Okay, divide it. So the last one is liquidity. How do we test liquidity now? Liquidity. This measures the bank's ability to meet its short-term obligation and maintain adequate cash flow. Ensure it can handle withdrawal loan demand. So I want to assume that liquidity is deposit is what the deposit is your liability, Abi. Loan and advances is your total assets. I would say total assets minus total deposit. That's my liquidity. So this is that correct? Hello, is that correct? Hello, is that? So hello. So my liquidity will be my, I can't say total assets. This total assets include my fixed assets. So I think my liquidity will be my loan and advances minus my deposits. So if you check now, it seems the bank is going to run into trouble. If you check, all deposits is more than their loan and advances, except they give us incomplete information, right? So liquidity simply means your loan and advances is your asset, while deposit is your liability. The customer money that is with you is your deposit. That's a liability. Then the asset you have is your loan and advances, your own money that you have lent out to people, what people are owing you, just like your receivable. So if I'm to measure the liquidity, I will compare.
We should use total assets. Use total assets.
No, total asset is not a working capital now. Total asset, it includes your fixed asset now. It includes your fixed asset. Your fixed asset is not a working capital.
Your ability to convert your fixed asset to liabilities and liquidity is also
total deposit.
To test your liquidity. Okay.
Yeah. Can assume total asset
so just say
total deposit.
Total asset minus total deposit, right? So just do that. Then you analyze it. So I think now we all have an idea of what Camel is all about. So let's leave Camel now. Let's leave Camel. Do we all have an idea of, if you see this question in the exam, do you have an idea of how to solve it now? So that is what Camel is all about. And it's a regular question in the exam. So I want to move on to another question now. So we've solved number one. Okay, let's take this number two now. Let's take number two. Fast. Print screen. Let's take number two. Let's take number two. So next question. This is the question we're taking now. All right, 2A. This is our third question tonight, Abi. Solution. Explain fully the way the man wrote fully now. Is he expecting us to write a full textbook? Explain fully what is meant by risk return trade-off, and explain how the concept is used to choose between two mutually exclusive investments. So there are two questions. Number one is risk and return trade-off. Can I just explain, or do you want me to pick the full solution from ChatGPT? Should I just explain and we'll move on? Or do you want a full solution from
Pick
ChatGPT?
solution and let us move on so that we won't stay long on this.
Okay. Explain fully. Explain, if I say it fully here, it will write, explain what is meant by risk and return trade-off. So the answer is coming. Let you type everything, then I will. It will write so many things for us. I don't want example of that. I just explain to me. The solution is long, so I will just copy it. Thank God, it's done. It's done. It's done. So you go and read and summarize. You are not expected to write it like this. Just summarize it for all of it. You are not expected to be. I don't expect it to be comprehensive like this. You will not. You may not have the time. So illustration. Risk and return. Show them. Explain fully. Risk and return. Then the second one is how the concept is used to choose between mutually exclusive projects. So mutually exclusive trade-off selection. So this one now, I can answer this one fast without looking at ChatGPT. So for mutually exclusive is accept. So these are the decision rules. Decision rules. Okay. Decision rule as follow. A, accept the project with the highest returns. Okay. Then accept the project with the lowest standard deviation and variance. That's all. So this is what they want you to say here. These are the decision rule. Okay. Now the next one is this. Given the data below, calculate the expected return, and the risk of the project, and explain to a layman the implication of the calculation to enable him take decision on the project. So this is the solution now. Solution. We have the year. How many years do we have? 20 base year. We don't need the base year. 2016 to 2020. 2016, 2017, 2018, 2019, 2020. Okay, this is the year we have. Then what else do we have for each of the year? We have price. Okay, it's similar to that one we saw before. Price. So what's the price and what? Price, dividend. Then we have our returns.
Return.
Price, dividend, return. So what is the price, please? The price is 5.13 is the base year. So you skip that one. 3.35,
3.35, 8.8.
3.35,
8.8.
8.8, followed by what?
7 point.
8.8, 7.95, 6.15, 7.95. Then 6.15.
6.15.
7.15.
7.15.
7.15.
Dividend 0.2. Dividend 0.2.
0.2.
Yes.
0.2.
0.25.
No, which year did you start from? From 0.2, 0.25.
2016 now.
0.2, 0.25. Oh yeah, give me.
0.26.
0.26. Oh yeah.
0.38.
0.38. Oh yeah.
And 0.45.
0.45. So can you calculate return for me fast? So
yes, new minus
if you want to
old
calculate
plus dividend.
If you want to calculate return for year one, it will be 3.35. It will be 3. This one it will be minus 3.35 minus 5.13 plus 0.2 divided by 5.13. So that's about 0.308. Abi? This one is
Minus
0.308 minus. So
Yes.
for this one, it will be 8.8 minus 3.35 plus 0.25, then divided by 3.35. So the answer is 1.7, 1.7015. Then the third year, so 7.95 minus 8.8 plus 0.26 divided by 8.8. We have minus 0.06767. Yeah. So here is 6.15 minus 7.95 plus 0.38 divided by 7.95. The answer is minus 0.1786. Then this last one is 7.15 minus 6.15 plus 0.45 divided by 6.15. 0.2358. So let's do the return. In this case too, we're not giving probability, Abi. So we're still going to follow our main and everything. So what is the total return? Total returns is how much? Minus 0.308 plus 1.7015 plus, minus 0.067 minus 0.1786. I have 1.3837. Is this correct, everybody?
Yes. Yes,
Then
correct.
mean or average returns is equal to 1.3837, 1.3837, 1.3837 divided by how many years? By 5 years. So this is how much? Oh, 0.27674. So yeah, so you come here now. This will now be your return minus your mean return. So you follow. I think can we complete it on our own to calculate your variance and standard deviation, or we should complete it together?
Just complete it. Complete it.
We should complete it. So, oh yeah, let's finish it. Fast. So let's finish it fast. So we need to calculate our return minus main return. So the main return is 0. So this one will be minus 0.308 minus 0.308 minus 0.27674. This is 0.58474. Okay. Then we have 0.7015 minus 0.27674. 1.4276. Then we have minus 0.067 minus 0.27674. This one is minus 0.34374. Okay. Then last one, minus 0.1786 minus 0.27674. This one is minus 0.45534. Okay. 4.2358 minus 0.27675. This one is minus 0.04094. Minus 0.40 minus 0.04094. So this is what I have. So you square this figure. Let's square it fast. Square it. We'll square each of them. So this is 0.5
0.3449.
0.3419. Second one, 1.42476 square. 2.0299. Okay.
0.118.
0.118. Okay.
11.
Then this one called
1182.
1182. What about this one? 0.45534. 0.2073.
0.2073.
Then this one called
0.001676.
Okay, let's add them together. Let's add them up together. I got
2.6989, Abi.
6699 or something.
6989.
You approximately just 99. You approximate the last one to give you 0. So we know our average return now. So what's our variance? Our variance is equal to 2.699 divided by what? N minus 1. How many years do we have? 5 years, Abi. It should be 5 minus 1. So what's our variance? This divided by 4. Our variance is 0.67, 0.675, 6747. Okay. Then what's the standard deviation? What's standard deviation? So standard deviation is this, which is 0.8214. Abi?
Yes, correct.
This standard deviation. So they said you should advise the investor. So what you're advising the investor is that the higher the standard deviation, you just explain the risk, explain the standard deviation, what the implication if it is high, and explain if the variance is high, and explain the returns too. That's what you need to explain here. So, but we are done with the calculation. Can I move on to the next question, please? Can we take the next question? Okay, so I'm happy that we are moving fast. Let's move on. Leadership questions. So we have done question number 1, we have done question number 2. Question number 3, I have not attempted it, so don't let me guess. Question number 4, we have done this number 4. It's in this solution. No? This my material here. You will see the solution of this question number 4. We have done it. Okay, so let me move on also. This one that involved Trenor, we should be able to do it, but I've not attempted it. I'm only solving the question that I've attempted. So this is another year. We have done question number 1. The solution is in this material, bond and everything. Then number 2, we've just done this one now. Number 3 is Carmen, which I believe that you should be able to do it based on the last question we solved. Number 3 is Carmen. Then this one, I haven't attempted it, so let's leave it. But if I'm able to solve this screen before Saturday, I can post the solution in the group. Okay, anyone I'm able to solve more. So there is one more that I want to solve, that to calculate better. Let's calculate better. That might be the last for today. Look at this question number 5B. calculate the beta coefficient of MBB security using the following data. So this is in Olowe's book. Oh. Are you with me? This question is in Olowe's book. They just changed the figure. I'm trying to tell you the page it is in Olowe's book. If you have Olowe's book, you can, although I will solve it for us together here. But this question was lifted from his book. Is in page, look at page 401 in Olowe's book. This question is there. So what we are to calculate is beta. And what is the formula for your beta? The formula for your beta is your covariance return on the portfolio into return on the market. Return on portfolio and return on the market, okay, divided by the variance of the market. So that's how to calculate this thing. Divided by the variance on the market. So that is what you need to calculate your covariance. Divided by the variance on the market. So let's quickly do that now. Let's do that now. So let's probably, this might be the last question for tonight before we call it an evening. Okay, this might be the last before we call it an evening. Hello, are you guys with me or people are already sleeping? Hello. Is in page 401. They just changed the year and everything, but the question is same concept. So let's solve it together. If you have Olowe's book, go to page 401. Calculator of beta. He gave us the formula in the class. You know, he was rushing us. I saw a full question. So let's solve this question now. This might be the last for tonight before we go. Okay. So this is the question. Calculate beta, coefficient of beta. We are calculating beta. So I was the year I gave it. Let me use table. Let me use table. So if I use table, we have the meta, return on security, return on market. Okay. Return on security, return on the market. So we'll just have to do it very fast. Okay, yeah. So solution now. Okay, I see. Let me draw table for this question so that it will look so neat for us. Insert table. Draw table. So this was extracted from Professor Olowe's book. So I have my year. This is my year. This is my return on security. This is my return on the market. This is my R minus R bar. This is minus RM minus M bar. Okay. No. Then if I do this, I think I have just one left and I'm done. Yeah. So let me draw this to finish. Okay, let's move on. So we have our what did they give us? They gave us year-end quarter. This is the quarter. Quarter they gave us. Okay, quarter. We have 2023 Q1. So let's list 2023 Q1. 2023 Q1. Okay. Let me just call it 23 Q1. Then we have 23 Q2. Abi. Then we have 23 Q3. Then we have 23.
As in, it's 13. It's 13.
13 Q4. 13 Q4. Then we have 14 Q1. 14 Q1. 14 Q2. Okay, 14 Q3, then 14 Q4. Then we are moving on to 15. I think 15 is the last one. So 15 Q1, 15 Q2, 15 Q3, and 15 Q4. Yeah, this is what we have. So we'll bring this is the return on average quarterly return. So we'll bring that's like the return on the portfolio. Then we have the market return. This is like security return. Let's call it SEC-R, or we'll just call it return on the portfolio. Then the next one is the market return. So return markets. So next one is the market return. So we need the data here too. This one is 13.92. This one is 19.75. This one is minus 5.82. Then this one is minus 3.16. Then this one is minus 10.68. Okay. Minus 10.68. Then after that, we have minus 5.17. Then we have 5.45, 0.58, 7.94, 9.48. Then we have minus 6.57. Then the last one is 21.25. Okay, so we'll pick the second ones too. 10.02. Let's just do it fast. 10.02, 10.02. Okay, 11.1 minus 0.1, 0.4. Okay, 2.4 minus 2.61.
0.7, 9.68.
9.68. 1.76.
9.18.
9.18.
7.34.
7.34. 4.1 and
7.19.
17. So what you will calculate first is what is the mean. Okay, you total all this one and calculate the mean. So what's the total of your returns? So that's the first thing you do. What is the total of your return? The total of our returns now, let's get it first. Total. What is total for return on the portfolio and return on the market? What's the total? Let's do that first. So 13.92 plus 19.75 plus minus 4. You have to be careful with minus. So we need the total of everything. 13.92 plus 19.75 minus 5.82 minus 3.16 minus 10.68 minus 5.17 plus 5.45 plus 0.58 plus 7.94 plus 9.48 minus 6.57 plus 21.25. So I got 46. Please, can somebody confirm? 46.97. So this is for this. So we'll do the same thing for this one too. Do the same thing. 10.02 plus 11.1 plus to be minus 0.1 plus 0.4 plus 2.4 plus
17.46.
70.
70.46.
70.46. So what the next thing you do is you would so this is this next thing you do. You do this return minus, so you calculate the mean of each of them. So let's calculate it now. So it is R bar. Your R bar, I don't know how to put bar here. Your R bar is equal to 46.97 divided by, what's the number of years? What's the number of years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Divided by 12. Okay. Then return on the market, RM. This is like R on return on portfolio. Is this R bar? So RM is equal to, RM is 70.46. 70.46 divided by 12. So what is the answer for each of these?
3.91 for the first one.
3.91. What about the second one?
87.
5.87.
5.87. So the next thing you do is that you do this RP, okay, minus, it is R bar, RP bar, RP bar. RP bar means mean of RP. Sure, you understand? I don't know how to put that bar here. How should we do it? Should I just say M? You know that M means mean of R. I don't know how to put it. It should be RP minus RP bar. Then you do the same thing here. RM minus RM bar. So I'll just call it mean of RM. Sorry, guys. Are you with me? Is it clear? I don't know how to put the bar. That's why I'm using. So it is R minus R bar, RM minus RM bar. Then once you've done that, you will now square the two again. So once you've done that, the answer you have, you raise to power 2 of it, and that is all. Then you can finish the rest down. So this one raised to power 2. You need to do this raised to power 2. Raised to power 2. RP minus MRP. Then you do this one's to raised to power 2. This one's to raised to power 2. This one I bet. You do this one's to raised to power 2. Okay, so we've done, so the first one we'll do now is the return on this, return on the market. Sorry, I'm checking. Return on the market, then we only square the market own. So it is only the return on the market that we square, sorry. It's only the return on the market that you are going to square. You won't square the second one. So this one, you square it. You don't need to square the return on the portfolio. This one raised to power 2. Then once you have done this now, the next thing you do, so the final thing you do is R minus R bar multiplied by what? The RM minus RM bar. So whatever you got in your R, this one now, anything you got here, you multiply it by, okay? Put it in, you multiply it by this one. And that's your final step. So this is what we are going to use to calculate your beta. You need this result to calculate your beta. So let's quickly do it fast. So this is right. It is live in Olawe's book, so, but not the same figure. So how do we do it now? We know we have 3.91, Abi. We need to subtract all this figure here from 3.91. Oh yeah, 13.92 minus 3.91. It gives me 10.01. 10.01. Everything minus 3.91. Then this one, 19.75 minus 3.91. 15.84. 15.84. So yeah, minus 5.82 minus 3.91. Here I have minus 9.73. Okay, minus 9.73. Then you do the same, which we are using Excel. Minus 3.16 minus 3.16 minus 3. So this gives us 7.07 minus 7.07. Then this one minus 10.68 minus 3.91. This gives us
0.59.
14.59. Yeah. So this thing is going to consume time in the exam. I don't know, within 30 minutes.
Minus 9.08. $1.54. Minus 3.33.
It's 4.03.
5.57. Minus 10.48.
The last one.
17.34.
So quickly, we will do the same thing for return on market, but that one will be minus 5.87. It will be 10.02 minus 5.87. So the same thing. 10.02 minus 5.87 is 5.87. That is the mean. Yeah. So the first one is 4.15. 4.15 now. Then 11.1 minus 5.87 is what we are subtracting from everything. So this one is 5.23. Yeah. Then this one is minus 5.82 minus 5.87.
No, minus 0.1.
No, minus 0.1.
It's minus 0.
Oh, sorry. Minus 5.87.
5.97.
This is
Minus 5.97.
Minus 5.97.
Minus 5.41.
4.4.
47. Minus 5.47.
Minus 47.
Okay.
2.4 minus 3.47. Okay, let's go.
8 point. Minus 8.48.
Minus 8.48, Sabi.
3.81. The next one.
3.81. How about this one?
Minus 4.11.
Minus
4.11.
Sorry. 4.11. This one, call.
3.31. 1.47.
Next one, 1.77.
minus 1.77.
Is it minus or okay, minus?
Minus.
And this one call?
11.32.
11.32. 11.32.
Okay, so look at the next four now. This RM, return on the market, minus mean of the market, you square it. So this answer we have here, we're going to raise to power 2 of everything. So let's do that. 4.15 raised to power 2. This one is 17.
17.2225. 27.3529.
Just a good question.
Negative 35.6409.
It can be negative.
Okay. 35.6409. 6409. 29.9209. 12.0409.
Yeah. 71.9104.
Yeah.
14.161.
14.1561.
16.8921.
That previous one is 14.5161, not 1561. 14.51.
Yeah, thank you. Correct.
10.9561.
2.1609. 3.1329. 128.1424.
So let's do a division of labor. Somebody should help us sum up all this figure. Okay, somebody should sum up there. Somebody should now do multiplication of these two. I will color what we are multiplying together. This one in yellow. Somebody should help us. We need to multiply them and put them here. You see, RP minus market means of RP, RM minus mean of RM. We need to multiply. Why someone should solve this one for us? So let me be doing the multiplication. 10.01 times 4.15. I got 41.5415. 41 points. Then here, 15.84 times 5.23. I got 82.8432. Then 9.73 times 5.97. 58.080. 7.07 times 5.57. Sorry,
6729.
Okay, what is the summation now?
369.
What is the sum? 369. 369.889. So this is the sum. 369.
Yes.
0.889, Abby.
Yes.
Okay, thank you. So let's continue. 14.59 times 3.50.6273. 9.08 times 8.48. This one is 76.9984. 1.54 times 3.81. 5.8674. 3.33 times 4.11. 13.663. 4.03 times 3.31. 13.3393. Somebody should be helping us to do the summation from the top.
8.1879.
9. 8.1.
8.5496. 18.5496. 18.
Yeah.
0.5496. 196.28.
So somebody should do somebody should do the summation for us.
So 604.6907. 604.6907.
604.69.
6907.
Like this, Abby. So
yeah.
Now, so so what is our covariance? Covariance is equal to this thing you have here. Covariance now is equal to this one divided by n minus 1. This one divided by n minus 1. This is your covariance. This is divided by n minus 1. Then our variance on the portfolio, our variance on the market, variance for the market, our variance on the market is equal to this market that we've gotten here, this one. Let me copy it. This is for the market. This is 12. So this one, sorry. This one divided by n minus 1. N minus 1. So what is our beta? Our beta is equal to covariance. Our beta is equal to covariance divided by standard deviation divided by the variance of the market divided by variance of the market. This is our covariance. So I believe everybody knows the answer now. So for this ones now, for this, we'll be having 604. This is 604. This divided by n. How many n do we have? How many? I think it's about 12, Abby. It is 12.
12, yes.
So 12 minus 1. That's 11. So find the answer. 12 minus 1 is equal to 11. So what's the answer?
$54.97.
54.97. 54.97. Then what about this one? This one is divided by 12 minus 1. So how much is it? How much is it?
Coming 369.869 divided by 11. That is 33.6262. 33.62.
33.62.
3.
62, Abi. 62.
63. 33.
32. 63. So what is our beta now? This one divided by 33.63. So our beta is what? This is what we are looking for since. What's it? What's our beta?
1.634546.
Yeah, 1.63.
1.6346.
So
Yeah.
that's the end. We are done. We are done. Oh, so this is what we are looking for since. So please just know how to calculate this better. You can see that most of the job is on this table. Okay, so please know how to calculate the beta. Let me stop recording. I can't solve any other question again. Even me, I'm tired. Let me stop recording. So I
As in,
think
go back to
this is
that.
how much. Okay, I have stopped recording now. So you say I should go. I will share this.